Welcome to How to Money with Cole and Cole.
I'm Cole.
And I'm Cole.
We coach people every day on their money and how to plan for the future.
As financial advisors, we're here to have an honest conversation and educate you on how to money. Intentionally and passionately to hit your money goals. And we'll throw in some sports talk along the way.
Our mission and goal of this podcast is to improve your money journey and help you create the financial life you deserve.
So let's talk money.
And sports.
Well, hello everybody and welcome back to How to Money with Cole and Cole. We have finally made it to episode number 10.
Double digits.
We're in double digits. I'm joined today, as always, by Cole Peterson and Cole Jaski. How's it going, guys?
Not bad.
Going
Not bad.
great. Going great. Glad to be here.
Yeah, that's
Beautiful
good.
weather in Iowa this week, so that's awesome.
Yeah, it has been. Last night I went to Des Moines and drove back and got caught in a huge storm. Had to pull over for 5 minutes.
Yeah, pop-up storms like all over the place. So we needed the rain, though. We got some rain last night, and it was like much needed.
Yeah,
it was
3/4 of an inch is what I heard.
Yep.
Yeah, it was pretty crazy. Where we were between Fort Dodge or between Webster City and Ames whenever we got caught in this pop-up shower, and it was like sheets of rain. So I was like, let's just pull over for a minute. So but no, things have been good. How's the financial world for you all?
It's been all right. It's been all right.
Good.
Market's rebounding a little bit.
Yep. It's been some positivity here recently. Where I think the Coles are slowing down on the golf course a little bit as the summer winds down. So we're working a little harder. You can just tell we got a lot more going on. Busy, keeping everyone hustling every which direction. And now we're getting closer to the school time. So kids will be going back to school. Everyone's kind of taking their vacations before school starts. So starting to transition to more of that fall type here pretty soon.
I know.
Say summer vacations are almost over, and I told Angie in the office this the other day, like I love spending time with my family, but I'm kind of ready for me to go back to work most of the time.
Just having the consistent schedule.
Yeah.
You kind of summer, July, June. There's
I feel like you never get caught up. You're
we get
always
invited
behind.
to a lot of things.
Yeah.
Yeah. Well, I was thinking about this. August 9th is when this comes out. That's like literally 2 weeks until school starts. It feels like this summer has just blown by.
Yep. And that day is 2 days before the preseason for the NFL starts.
That's insane.
Yeah. This episode will come out August 9th.
That's
the
crazy.
preseason starts on Thursday. I didn't see who the game was, but
they're in camp now.
crazy.
Actually, most teams are all reported to camp and going full bore. So
Aaron Rodgers showed up with the what was it? Nicolas Cage impression or something like that.
Oh yeah,
that's awesome.
and then the Bills-Rams, September 8th, first game of the season, NFL.
That's gonna be a good game.
Yeah.
All right, so
that's 1 month after the podcast. Next podcast is this podcast will be released.
Yeah. Okay. So this was not on the agenda, but since the preseason starts August 11th, without seeing any football, who's your Super Bowl pick? You're way too early Super Bowl pick.
Let me think here.
So last year it was Packers, and
No.
who's in the NFC Championship game? Was it Niners and
No.
Rams? Niners and Rams.
Yeah, I was gonna say Packers.
And it was Bengals and
got bounced.
and Chiefs.
Yeah.
Oh, my gut. I have a team I want to say, but I don't want to say it because it's Cole P's team.
I was just gonna say. I think the Broncos will be in it.
Yeah, they're
going to
be close.
They're gonna be good.
I'm gonna go. I'm gonna go the Rams to repeat.
I go
Rams to
Packers.
repeat?
I go Packers. Broncos in the Super Bowl. Broncos get it done.
Packers will not make the Super Bowl.
Okay.
I do not
All
think
right.
so.
Well, you heard it here first. So
Yeah. So I don't really. Okay, let me just pick a team. And I'm not going to pick the Rams because that's just like
Too
easy. Yeah.
Yeah, come on.
if they
Cole,
win, though, that's like.
Yeah.
I'm a Matthew Stafford fan, so.
Yeah.
You know, the last repeat championship was like 30 years ago. Like barely ever repeat. It was the Broncos, actually. 98, 99.
No,
Yeah.
the Patriots have repeated.
With
Brady,
maybe they did.
with Brady they have.
You're right. You're right.
That was incorrect. Fact check him.
All right. Well, it's 20 years ago. Doesn't happen around.
Just because, and I know nothing about their team, I'm just going to say the Chargers because Herbert seems like a stud.
Boo.
Yeah.
I don't want to pick the team that you picked, and I don't think the Chiefs are going back because they've lost a lot. So
Yeah.
Odds are we'll probably all be Super wrong.
Yeah.
So we'll know, and we got it on record.
It'll probably be like the Carolina Panthers with Baker Mayfield.
Oh gosh.
All right, we're gonna get into the financial talk here, but and we know we're supposed to keep our sports talk to a minimum.
Yeah.
But also, last thing on sports, Major League Baseball trade deadline's coming up. My Cubs have won 6 in a row as of today, which we're recording this on July 28th. They're going to trade the best player, Contreras.
That always
I know
stinks.
they have to.
That's such a weird thing. I mean, that always stinks. Baseball happens so much, where a team's so bad and they've had a player and a really good player, and it seems that player gets traded.
And catcher is it's a hard position, and there's not really a lot. He was the All-Star this year. I mean, there's not a lot of good catchers in Major League Baseball. So they're going to get a lot for him, and they're building they're building it. There's
optimism here.
17 games under 500 right now. Next year, I bet they're 50-50, and the next year we're going to the playoffs. That's the plan.
All right.
That's the plan.
Couple calls here today on way too early. Future calls here.
Right,
so we know that in 2024 the Cubs will be in the playoffs.
We'll be in the playoffs.
I'll
almost put money.
I'm going to hold you to that.
If there was a futures bet out there, I'd put it on.
All right, we better rein it in here and get back on the money conversation.
Yeah, I suppose. So we have a couple announcements to make before we get deep into the money talk, and that is, we have CFG Podcast has a YouTube page. It's just under Central Financial Group, so go make sure you subscribe to that. You can watch the video format of this podcast if you like.
Yeah.
Also, I don't know this, but I could guess that maybe at some point there might be some sort of video content that you would want to see. So go subscribe. Also, make sure you like and share this podcast. It's on all podcasting platforms: Apple, Spotify, Amazon, Google. It's on all of them. It's on their website. And then, next episode, we have a special episode we're going to be doing. We're going to be doing a Q&A announcement with questions from our listeners. So what we're going to need you to do is, we shared a thing on Facebook for them, and it's on their, I believe they have a spot on their website. You can do this. You can stop by the office in person, call the office, check them out on LinkedIn. There's a lot of different ways to do it, but drop your questions for Cole and Cole to answer on the next episode.
You can remain anonymous if you don't want your name read with your question.
Yes.
But yeah, we'll answer the questions. We'll read the questions next episode, and then we'll answer the questions.
Yep. And we're looking for, a wide variety of topics. We're open from the early on investor, retirement saver, to someone that has a very specific, detailed question. We're open, and we just want to open the conversation.
And honestly, if you have a golf question or a sports question, we're open to that too.
There we go. Yeah. You can give us I'd love that.
Yeah, I was gonna suggest sports too, but yeah. So if you have a question, leave it in one of the places for us, and we will do that. The deadline will be August 10th, tomorrow, and hopefully you already have heard about this, so that some people have gotten their questions in. But if you haven't, you have till tomorrow at 5 o'clock to get your questions
if they
in.
listen to that on August 9th, if they listen to the podcast the day it comes out. But yeah, August 10th will be the deadline.
Yeah.
To get the questions in.
Yep, and we will do our best to answer as many as we can within the time restraints. So that's just a little bit of business that we had to take care of on here. So with that being said, they have a topic today. We're going to be talking about
income planning, retirement income planning. So, you save all this money, or most people save up all this money to get to retirement. And then it's, how do I take the money out and pay myself in retirement? So Cole, talk a little about how we as financial advisors help people plan for income and retirement.
Yeah, I think obviously one of the biggest concerns people have is, will I have enough money to retire? Where is my income as my salary or whatever it is, that you're living on now stops and you retire and transition? Where is that income or replacement going to come from? And I think the first thing we always discuss with clients is what are the objectives? What do you need? What do you want to do? And that's always the first step, is defining the priorities and objectives of what you want. Some people need a little, some people want a lot.
Right.
And that's going to dictate, not only how much you needed to save, but also, if you're like, hey, here's what I need, and I know I need, here's the bucket of money I have, can we do it?
I have people on my planning software. I have one couple that plans to spend $2,000 a year on travel. I have one couple that plans to spend $40,000 a year on travel. So there is no magic number that is for everybody. It changes with the plan, and that's why we do a plan and try to set up this income planning so it fits your plan.
Yep.
So there is not one distribution strategy that we're going to talk about or anything like that, but there are some just general things that you can think about. Obviously, when you get to retirement, most people are going to have Social Security income.
Yep.
You might have pension income. That includes IPERS here in Iowa. Other income sources can be farmland, part-time employment, things like that. So we are just going to talk about the money that you have in your IRA, 401k, Roth IRA. We're going to talk about distribution out of those and how you take money out, to live. It's supplemental income is what it's called in retirement. So it's to supplement all those other income sources that you may or may not have. It's what do I take out of my investments? And it might be zero. I mean, I have some people that don't take any money out of their IRAs. They're just letting them grow and use them for a rainy day.
Yep, there's a lot of people that continue to save well into retirement. A lot of people have that misconception, I've saved all this money in the retirement buckets. Don't need to send it. And sometimes that's a great thing for people to have if they don't have to put any pressure on their liquid assets because they have pension, Social Security, IPERS. That makes it a lot easier on the assets, and still need to have a plan, an idea, and then the goals might just change. It might shift to how do these assets transition to my spouse or to my kids or my heirs at some point. But what are I guess kind of shift it back to you, Cole. What are a lot of the the major concerns you see, that you've ran across for people, I guess?
I mean, the number one thing you kind of already touched on is do I have enough money? Mm-hmm. Do I have enough money to retire? Am I going to run out of money? We try to do our best to predict that and obviously advise you if you haven't saved enough to maybe work a couple more years, things like that. But I think the best thing that people can do, and you've talked about buckets, have more than just one bucket. Don't just have your Social Security IPERS bucket. Have a IRA bucket, possibly a Roth IRA bucket. If you have multiple places, that's probably the most successful people that I see in retirement is they have multiple places to pull money, and we can put their plan together to do the right thing at the right time. So the power of Roth distributions in retirement, talk a little bit about that and what's the difference between me pulling because we got all this other money over here that's taxable. Yep. Pension, Social Security is taxed at a certain rate, but what the power of a Roth IRA in retirement.
Yep. So we're talking really think of two different buckets of money. Pre-tax, after tax, right? That's the kind of the terminology we use, or traditional IRA or Roth IRA. So the big thing with the Roth is the distributions all come out tax free. They're tax free on the state and federal level as long as they're used, in accordance to the rules, which you need to be at post 59.5. That's really the main caveat with the Roth for retirement planning. But that's the biggest piece is you get that same if you're contributing to a Roth all your life, that same tax deferral where you're not paying any taxes on the gains or anything there, and then you go to use it. It's tax free. You don't have to claim it as income and pay taxes. So you're not losing that 10, 15% or whatever, your income tax bracket would be versus same bucket of money, same exact example with the pre-tax or the traditional IRA bucket. You pull those dollars out. You are now netting 85% of that if you're paying 15% of taxes. So the biggest difference is the Roth bucket can last a lot longer because you don't need to pull as much out to get the same dollar amount that actually hits your bank account for you to be able to spend. So right. I think that's a big piece. We talk a lot about conversions, a lot of different strategies, but that I know we're always pushing the planning aspect, but that's why having a plan is important. So we can say, hey, what's the most efficient bucket for you to maximize? Because doing one versus the other could have a big impact, especially if you're planning for longevity. And I think that's one thing the industry's really changed. Cole, I don't know if you'd agree with that, but when we use our planning software, the ages each year they keep going up, right? So
because people are living longer, obviously.
It's a big concern. I think of ours when planning is when someone says they're going to run out of money. what if you live to 100? We got to somewhat have a contingency for that.
Right. When Social Security was enacted in like 1952 or whatever year it was, I don't remember, the average age that people died at was like 63.
Yep.
Well, Social Security set the age at 65 to collect Social Security, so a lot of people didn't even collect. Now it's like average age that you die is 82.
Yep.
So everyone's collecting for like 17 years. Well, that's why Social Security is having a problem, and that age is just going to keep going up and up and up, obviously. I mean, I can't even imagine what the age prediction for you is, Caleb. Being 14 years old, you're probably going to live to be at least 100.
I think that's
something like that.
A common question, actually. I'm going to pull this off the cuff here of, Cole, how do you respond to this question? I'm a client, a client of yours or a prospect of yours, and Cole, am I going to have Social Security available to me?
Oh my goodness, yeah.
All depends on how long you live.
Well, what they're talking about is Social Security is set to be solvent in year 2035 or whatever year it is. And what solvent means is that it will only be able to pay out 75% of what they were promising people.
Oh, wow.
Now, Social Security, and it's always a government thing. Social Security has borrowed money from Medicare before. Medicare is actually in a worse place but we won't go there. But Social Security has to make like 2 changes, and then it stretches to 2080.
Yep.
So most people that we talk to, and people that like me and Cole, Social Security will be there for our entire retirement and until we die. I'm not going to promise anybody anything because I don't control the government, obviously, but I do not anticipate them going away from Social Security benefits.
I think a good rule of thumb, too, that I've kind of used, and I stole this from someone. Unfortunately, I don't have any original ideas. Generally, I've got all my good planning tips and something from someone else. And but if you're under 50, let's try to build a plan without it. And if it's there, great. If you're above 50, there's probably going to be something there. Whether it's 75%, 50%, 100% of your benefit. I don't know, but that's
funny because like all my plans, I never eliminate it.
Yep. Yeah.
So it's a difference between me and you, like, and that's why no one plan is the same, and that's why there's not one way to do everything with a financial planner. Even me and Cole that sit right next to each other in the office do things differently. I think it's one of those questions that we get a lot, but in my mind, Social Security is going to be there forever. So.
This podcast is produced by Spin Market and Digital.
Located in Fort Dodge, Iowa, Spin Market's highly skilled team can help you increase your market by updating your website, improving SEO, designing advertisements, and producing podcasts that will grab the attention of your market.
Contact Spin Market today for all your digital marketing needs at digitalagent@spinmarketwith2ks.com or call us at 515-302-8026. And to learn more, visit our website at www.spinmarketwith2ks.com.
That's digitalagent@spinmarket.com or 515-302-8026 or visit our website www.spinmarketwith2ks.com. All right, guys, welcome back to How to Money with Cole and Cole. Thank you to Spin Market for everything they do for the podcast. So before we continue with the money talk, I have to throw out this little tidbit of sports information that I learned yesterday or maybe the day before. And it's a pretty big thing for Iowa college teams is there is a 5-star recruit from Waukee who committed to Iowa State yesterday, I think for the 2023 class. But
he's a senior this year.
Yeah, he'll be a senior. So either way, for Iowa State to land a 5-star recruit after 2 years ago being 2 and 20 something,
right?
TJ
Highest
Otzelberg
recruit ever at Iowa State.
Yeah, that's what I was going to ask that too. What is
he's like number 7 in the nation or something like that?
That's crazy.
TJ Otzelberger is building a program
Yeah.
very quickly, and I'm excited for Iowa State basketball again.
Yeah, they're gonna be fun to watch.
They're going to be on the radar for a lot of things this year, and coming off a crazy, like one of the best turnarounds of all time, I would say, in college basketball.
Oh yeah,
from 2 wins to what they did in the run they made last year. So
went all the way
good for the Cyclones.
Yeah, so
a little bit of golf news too, Cole. Right?
Let's hear it.
What little Paul Casey and Bubba Watson went to the LIV tour.
More live drama. Is it?
Oh
I know we asked this on one of the podcasts. Live. I've heard, but even like the announcers say it differently. But
yeah. I don't think that everybody knows. But
pretty crazy. The narrative's quite changing. You know, I think a lot of people were, even Caleb said, "Oh, it's all just a money grab." But I think the more we get into it, you know, there's a little more to that. Maybe the control the PGA Tour has really had on the players, and the players are just realizing there's options. And
that's the thing, is they had no other option.
Yeah.
And now they got another option where they can basically dictate how much money they want to make, how often they want to play.
It's a little bit more comparative to the other sports.
Yeah, they don't have somebody
telling them.
telling
Like that. It's like, yeah, that sounds a lot better.
Right.
And they don't play as much.
They don't play as much, and they get paid more. I mean, if I didn't have to work as much and I got paid more, I mean, I think I'd do it.
Yeah,
yeah, I would too.
Did you guys see the hole-in-one by Mark Hubbard?
No.
I just saw it, I think, right before the podcast.
I have. Yeah, I know you mentioned that. I'll be honest with you, I have not seen it.
I think it was at the tournament this week. So he hits the shot on a par 3, and he doesn't throw his club, but kind of like slouches and like turns around. I was saying it was like such a cool jazzy shot. I think he thought he chunked it. And it hits in the front of the green and kicks straight forward and starts breaking left. It goes in the hole.
Oh my god!
And he throws his hands up. He's like, "How did that just happen?"
That's probably something that would happen to me.
I feel like a lot of hole-in-ones are maybe not like quite like that, but they're like, when it happens, you're like, did that just happen?
Yeah.
So
yeah.
That's exactly
because
right.
Cole hit a shot sometime and like it goes on the green. I'll be like, "What's wrong with that?" Like it's like 20 feet away, and I'm like, "Well, yeah, but you're on the green."
Too high of expectations sometimes.
Yeah.
Anyway, well,
right.
that's as much as we can get into that.
Yeah,
today,
let's get off the sports talk.
Yeah. So I heard you guys talking beforehand that there's going to be some changes in the tax laws in Iowa, which has to do with retirement and stuff like that. So
good news for Iowa.
Good news.
March 1st, when this came out, or the news came out, there was a tax. Basically, some tax adjustments for the state of Iowa. There's some good on the retirement planning side, as well as just on the personal income tax side. But yeah, as far as the relevance to retirement planning, big deal, right?
It's huge. So what we're talking about is typically right now when you take a distribution that is taxable, which is IPERS, Social Security is taxable at a lower rate, but it is taxable out of your IRA. It's all taxed at federal and state taxes right now. You pay a federal, whatever your rate is, 10 to 25, 30%. And then state taxes are typically between 4 to 9% right now, let's just say. The state taxes on all retirement distributions starting next year are eliminated. So that means your rate goes from whatever you're paying right now, say it's 4, 6, 7, whatever it is, goes to 0.
Yep. And it includes your IRA distributions, your Social Security, IPERS, pension, and I know there's Cole and I were kind of talking about this a little bit. It also talks about annuity distributions as well. There's one thing that we don't want to go too in depth because it's crazy it passed, but there's not all the details are out. Just like
right.
Same time every time the government does something, they give us a snidbit, but not the full details or the what if scenarios. So there is a few things there, but I think it's very relevant for people planning into next year or looking at, hey, should I take extra money out at the end of this year or wait to next year? Probably a good idea if you don't need to do it. Let's wait and save yourself that 5% or whatever it might be on the state income tax for next year.
On our retirement income planning earlier, I mean, I've talked to people that I had set up IRA distributions, and I said, hey, if you're sitting on cash right now, let's wait till next year. Let's stop the contribution or distributions for the rest of this year and then start them back up next year. If you can sit tight for 6 months without getting that extra, whatever you're getting, $1,000 a month, it's not going to save you that much money, but it'll save you a little bit. I mean,
money's money.
Anytime we're going to save money, yeah.
And really the only, caveat to this that we can read, and I'm pulling this from the governor's bulletin, is on the age, because that was one thing. Is like, well, what's defined as retirement age, for retirement distributions, and really all it says is you got to be 55. So even if you are still working 55 and you pull some dollars out of a retirement account or whatever, or say you kick a pension on or something you kick early, you aren't going to pay state income tax on that piece. So
one thing that I did, sorry, I thought you were.
No, you're good. You're fine.
One thing that I did confirm is that I had a gentleman ask me, okay, so what if I'm working in retirement? Do I still pay state taxes on my wages? Yes, you do. This is only on money that you take out of retirement plans or a pension or Social Security payment. If you are working getting W-2 1099 earnings, you still have to pay state taxes on that.
That makes sense. I mean,
but it is going to be cut down to a flat tax of 3.9%. So
so 2 changes of state taxes. But let's go down that route some other time. Yeah.
So that's a big thing for anybody.
Yeah. So I had a client just last year that moved to Florida to avoid state taxes. He was fairly well off. State taxes, they do not pay state taxes in Florida as far as in income taxes. I don't know if he's moving back, but it's that people have moved out of Iowa or moved to a different state to avoid state taxes in retirement. Hopefully they'll be staying now.
Yeah, that'd be good. So RMDs, tell me about them because I don't know anything about them.
So what RMD stands for is required minimum distribution. So we're going to a different topic. We're going off the Iowa state taxes, and we're going to what are required minimum distributions. So Cole, I'll just let you just generally tell people what required minimum distributions are. Yeah.
So basically, what an RMD is, and that's what we'll use RMD for short terminology here. But that's if you have and I'm going to use the pre-tax bucket, traditional IRA, or pre-tax 401k bucket. If you have, some type of dollars in those accounts and it's your own account that you are the owner of, and you reach now the age of 72, which has recently been changed, you are required to take out a certain dollar amount that the government basically says, hey, we want you to take that and realize some of that income and pay some income tax on it. Because none of that money, if it's a pre-tax account, you got a deduction at some point and didn't pay tax on the dollars when it was coming in. And they basically say they don't want you to defer that and just pass it on and not get any income tax on. So right now, if you hit age of 72, the year you hit 72, you have to claim a certain portion of that. And there's basically a chart that the government puts out that's based on your age and the balance. And it's calculated at the end of every year of what that dollar amount is that you're required to take out. Now, you can take out more, but you can't take out less. But, one big thing this is an important thing for people is what happened, talk about a little bit if they miss the distribution or don't take it out.
Yeah, if they don't take the required minimum distribution out, the penalty right now is 50%. So if you have an IRA and you're required by the government to take $10,000 out, let's say, the next year, if you didn't take it out, they will tax you 50% on that, or penalty, excuse me. Plus, you still have to pay federal taxes.
I mean, it ends up being, it could end up being like 65, 70% penalty. So it's a big deal for people to not take lightly.
And it's not like it's automatically happens. Like, we have to set this up for you as financial advisors, or you have to set it up. If you're not using a financial advisor, you have to, track it yourself. So, we try to help our clients plan for, okay, so we know what your RMD is going to be on January 1st of the following year. Yep. We don't work January 1st, but on January 2nd, let's just say we know what it's going to be because it's based on your balance 12/31. So we have the entire year to discuss your RMD with you, what you want to do. I have some people that take them monthly, just want to use it as part of their income. I have some people that do it all in December because they want to take it out last minute. Some people that take it right away in January and they want to use it all year. It's different strokes for different folks when it comes to that. So, sorry, I didn't end that very well.
That's okay. I just didn't know where we were going.
Didn't leave a good transition point there.
Yeah,
different strokes for different folks. It's not something that we can do the same thing for everyone. As is many of the stuff that we talk about. So,
yeah.
Let's move to a different topic: inherited IRAs. And they've changed a lot of rules lately. So
I know we're talking about a lot of legislation,
right?
Here.
Legislation, and we don't try to play a politician by any means. But inherited IRAs, before it was a pretty easy topic for me and Cole. Everyone inherited IRA, and you could take it. You could take it all out, or you could stretch it out the rest of your life. That were the two options basically. Now, if you inherit an IRA and it's not your spouse, you have to take all the balance out within 10 years.
And he's referring to, RMD, the same thing, required minimum distribution, but now we're going down to the inheritance level. So say you passed away or your parent passed away. That's what he's talking about. And your non-spouse. Spouses have a whole different set. They basically just it turns into their own IRA. You know, from that standpoint. And we're speaking in generalities here, so don't fact check us too hard here. But these are general rules. There's always specific nuances to certain situations if it's a minor or whatever it might be when things happen. But that recently changed as well, where now someone, say you inherit a big retirement account from your parents, mother, father, whatever it might be, you have 10 years, as it sits now, 10 years to deplete that account. Again, we're still waiting on some guidance. There's a few nuances, and there's been some recent bulletins on this that the government's put out.
I'm listening to a conference call today because they still haven't come out with some of the details on what we need to know about this, even though it's right now technically law.
Yeah.
So
interesting.
Yeah. It's like they want to just put the rule through as fast as possible, but they don't want to give all the details. And we can go down that road some other time. But So what we're saying, or what we're making sure people know, is that yes, it's great to inherit money. I'm sure people would love to inherit $1 million IRA from whoever. If my uncle died and I inherited $1 million IRA, I wouldn't be mad. But at the same time, I have to take all $1 million out in the next 10 years, whether I do it $100,000 each year for 10 years, or I wait 10 years, take all $1 million out in the 10th year. I have to pay taxes on all that money. Right now, you only have to pay federal taxes if you're in Iowa, but if you're in a different state that has state taxes, you would have to pay state taxes. But that can impact people's livelihood. I mean, life just, yes, you inherited all this money, but your tax bracket is going to be, affected.
It's one of those things, shifting back to having a plan too, right? If we know, you're not going to spend a lot of that money as someone that has a big retirement account, whatever it might be, of no one understanding how that transitions and educating, like, hey, if this happens or something unexpected happens, this is, going to impact the beneficiaries of that account and, net tax wise. And there could be some things to alleviate that. And we're not going to go down that. There's a lot of different strategies to talk about, but that's where opening up that conversation is so important. Say, hey, do you realize this bucket's going to happen this way if you don't spend it down, or whatever it might happen, of understanding the back end ramifications, and maybe that impacts the distribution strategy of what bucket maybe you're pulling from first, or differently, just based on how the accumulation happens. But again, always coming back to, educating yourself and making sure you have a plan, or speak to a professional like Cole or myself to talk through that conversation.
What Cole's talking about is called legacy planning.
Yep.
So how am I going to pass my legacy on? Do I want to make it tax efficient for the next generation? If you don't, then you don't have to do any legacy planning. But a lot of people that we talk to want to. So
yeah, they don't want to be too hard on their kids.
Right. They don't want to
I'm always saying I'm just going to spend all my money, and that's what they get. What's left. Left. No.
Leave them with nothing.
Yeah. Well, there you go.
Yeah, well, that's pretty much going to wrap up this episode. So once again, thank you all for listening. We hope you enjoyed it. We hope you learned something. And
questions. Remember to submit your questions.
Yep. Submit your questions to the website, Facebook, LinkedIn, in person, phone call.
Call the office. Email me if you want to. Email Cole. However you want to get it submitted. We will want your questions, and we will try our best to answer them all. Yep.
We will answer as many as we can in the time restraints we have. And any ones we don't have, we will put in the basket to answer the next time we do a Q&A.
Absolutely.
So eventually, all of the questions will get answered. Again, like, share, subscribe to us on YouTube, like and share it on just your podcasting platform. Maybe you know somebody that you think this would be useful information for them. Send it to them, text them the link, all the different ways that you can listen. So we hope you enjoyed this episode, and we will see you next time on How to Money with Cole and Cole.
Go Cubs.
You've been listening to How to Money with Cole and Cole, the podcast of Essential Financial Group, courtesy of Spin Market. Learn more about the Central Financial Group on their website, www.centralfinancialgroup.com.
For now, I'm Cole.
And I'm Cole.
And we'll see you on the greens.
Securities and investment advisory services offered through Royal Alliance Associations Incorporated, member FINRA, SIPC. Royal Alliance Associations Incorporated is separately owned, and other entities and or marketing names, products, or services referenced here are independent of Royal Alliance Associations Incorporated. Material discussed is meant for general informational purposes only, and it is not to be construed as tax, legal, or investment advice. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Past performance is no guarantee of future results. Diversification does not insure against loss. Any guarantees discussed refer only to fixed insurance products and are backed by the financial strength and claims paying ability of the issuing insurance company.